Back to Patterson on Properties. Hopefully, you guys are having a great and exceptional day. All right, hopefully this works this time. So the real estate market is in a wonderful and very, very eventful place this year. 2026 is basically interesting. Just like the other investments, the value goes up and it goes down, and it's all about mindset of the investor and the situation of the economy. According to the article that I read the other day, the housing data has real estate investors weighing whether real estate is still the smartest place for their money or whether a different path now is on the horizon. Now, before I go on, I personally think that real estate will always be a great investment because people will always need a place to live, and certain businesses will always need a place to have some sort of a headquarters at the end of the day. But it's all about where one decides to purchase some money and purchase investment properties all at the same time, because real estate has traditionally been one of the most reliable ways of Americans to build long-term wealth. It rewards patience, requires only a fraction of the purchase price in cash up front, and hands owners direct control over an asset that is historically appreciated. But with high financial inflationary times we live in, high maintenance costs, high insurance costs, high personal property taxes have skyrocketed, making it much harder to maintain people's properties, investor properties. That path to owning real estate has grown more complicated in 2026. The average 30-year fixed mortgage rate sits near 6.51%, according to the Freddie Mac, up from a recent low of 5.98% in late February. And the fast price growth that defined the market for much of the past 5 years has started to cool. In a sense, that's why they propose a 50-year mortgage, basically, paying double or triple for the property, and basically never even having the opportunity to truly own the home. It's just a deal that works out for the banks, works out for the county, and works out for insurance companies all at the same time. So in April, in short, pending home sales have only increased 1.4% in April of this year, 2026, prior to previous months increasing 3.2%. Borrowing costs have elevated, making it impossible for certain investors to borrow money. Members of the Bigger Pockets podcast, which is a great podcast, I need to start watching again, stated that buying small businesses has emerged as a popular alternative to purchasing residential properties. Foreclosure-driven bargains are scarce as well, with distressed sales making up only 2% of April's activities. Competition has not disappeared either, as a typical listing still drew an average of 2.5 offers. So buyers are still racing to purchase homes, but there's still a growing amount of renters versus qualified home buyers in 2026. So key takeaways for 2026 entrepreneurs and real estate investors. Pending home sales beat expectations. Pending home sales index advanced 1.4% from March this year and ran 3.2% ahead of the prior year. A rebound few forecasters had penciled in after a slow start to spring. Home price growth is losing momentum. Existing home values rose a marginal 0.9% over the past year as of April. And it's been reported with distressed sales running at only 2% of all transactions. The foreclosure discounts some buyers have largely vanished. Basically, you don't see a significant amount of foreclosures like you did back in 2007, 2008 timeframe. Buying a small business is another path, according to the Bigger Pockets podcast. Basically, being a venture capitalist, acquiring small businesses that are profitable, and getting the dividends off of those businesses. Acquiring Minds host Will Smith laid out entrepreneurs through acquisitions in which buyers purchase an established company. Such businesses often sell for 3 to 4 times annual earnings, with Small Business Administration loan covering all but roughly 10% of the price. ETA is demanding, not passive, and acquired business can become a 40 to 60 hour week job. Smith warned, and he flagged that the opportunity is often oversold as competition for quality deals intensifies. There's a low commitment way in. Rather than operate a business directly, Smith noted that investors can put $25,000, $50,000 into someone else's acquisition, gaining exposure to the model without running the company. And it's just like I said, in a sense, it's a smaller version of being a venture capital if you have that kind of that kind of capital and liquid assets to be able to put into another acquisition of a business, in hopes that everything works itself out. So we'll see what happens. Like I said, this is we're in the middle of half of the year. 2026 is over with. Things are not looking good. I will be blatantly honest. Job market's in the tank, economy's in the tank, everything's overpriced. But you just have to see at the end of the day how things end up and how things transpire. All right. So on that note, don't forget Patterson Up Properties. We wholesale real estate in the DMV area, as well as and Pennsylvania area, specifically Philadelphia, Lancaster, Reading, Harrisburg, all that good stuff. So check us out and go from there. And obviously, if you're a stock market investor, crypto investor, individual retirement account investor, don't forget to check out wewill-acornscrypto.com, Coinbase, all those platforms. You'll be able to make money moves, so hopefully you don't live broke like a fool. And remember, you can't get fired if you own the company. It's 2026. It's time to get on something. Do the great things, like, share, and subscribe. Have a great day. Make money moves, or get live broke like a fool. The same Spanish. Bienvenido a la vida. Welcome to the life.